Alright, welcome class. Today we'll discuss chapter 11 on financial reporting concept using accounting principle 9 edition by Wiley Plus. This is owned by Wiley Plus in terms of publishers. Alright, today we're going to discuss a number of learning objectives with text 1 to 5. Explain the importance of having conceptual framework for accounting. Explain the objective of financial reporting. Apply the fundamental enhancing qualitative characteristics of the conceptual framework to financial reporting situations. Apply the recognition and measurement criteria of the conceptual framework to financial reporting situations. Also apply the foundation concept, assumption constraint to the conceptual framework to the financial reporting situations. Yeah, the conceptual framework of accounting, the objectives in terms of financial reporting, there's quite a number of elements. Financial statement, the qualitative characteristics for use of financial including the fundamental characteristics, enhancing the qualitative characteristics of the application, and the difference between IFRS and ASPE. Okay, recognition of measurement criteria is based on the general revenue, expense and recognition criteria, and measurement of elements, error and intentional misstatement. Okay, foundation concept, assumption, constraint, based on the concept of consumption, constraint, and summary of the framework. Alumni objective number 1 is to explain the importance of having conceptual framework of accounting and list the key components. In foundation accounting, ensure the existing standard and practices are clear and consistent. Okay, that's the key part. Provides guidance in responding to new issue and developing new standard. Assist in the application standard, and as well as increase in understanding and confidence in financial statement and standard built on just general principle, not rules. Okay. In terms of conceptual framework, the key component is that always use professional judgment and framework to determine the appropriate accounting treatments. That is the key part. Professional judgment. That's the key part, okay? In accounting treatment. The key component of the framework will be number 1. Now 1 to 5. We're going to discuss this later. Objective of financial reporting and user needs. Number 2, elements of the financial statement. Qualitative characteristic, 4, recognition and measurement criteria, and number 5, foundation, assumption, and the constraint. That's the conceptual framework. The key part is applying your professional judgment in your accounting treatment. Learning objective number 2, explain the objective financial reporting and define the elements of financial statement. Is to provide information that is useful when making decisions about the business for investor and creditors. To give information about economic resources such as assets and claim on those resources such as liability and equity, changes in resources and claims on them, as well as economic performance. The objective is enable user to decide whether management use the company resource the best way possible. Refer to stewardship. Okay, let me just grab a few water here. So the key part is very important, guys. We're going to look into the next statement, the concept of pyramid here. We have the fundamental concept at the bottom. You have the recognition and measurement on the second level. Third level will be qualitative characteristics. Fourth level will be element of financial statements such as asset, liability, equity, revenue, expenses, and then in the top one, of course, we have the objective. So, okay, the objective is always at the pyramid at the top. Excuse me. And then elements of financial statement, we have the basic categories that are used in financial statements such as asset, liabilities, equity, revenue, expenses, must be precisely defined and applied in the same way for all reporting entities. In terms of financial statement, asset, here's the asset. Is a asset that represents resources controlled by a business as a result of past events that has been potentially produced for economic benefits. Liability, however, is a present obligation arising from past events, the settlement of which include transfer economic benefits. Obligation is a duty or responsibility that the entity has no practical ability to avoid. Equity is a residual interest in the asset of business after deducting all its liability, which is asset minus liability equal to equity. Revenues are increases in asset or decreases in liability that result in an increase in equity other than those relating contributions from owners Under IFRS, revenue include gains. Revenue arises in the course of company ordinary activities, and while gain may result from ordinary activities, while expenses are a decrease in asset or increase in liability, the result in decrease in equity are than those relating to distribution of owners. Under IFRS, expense also include losses. The expense arise from the company ordinary activities, and loss may not arise from any company ordinary activities. Objective number 3, which is applying the fundamental and enhancing qualitative characteristics of the concept framework to the financial reporting situations. To be useful, information should have two fundamental qualitative characteristics. Number 1 is relevance. Number 2 is faithful representation. These are the two characteristics: relevance and faithful representation. Two characteristics. Remember that, okay? And the characteristics also enhance usefulness of the accounting information such as comparability, verifiability, timeliness, and understandability. Accounting fundamental characteristics in terms of relevance. Accounting information has relevance if it makes a difference in decisions. Relevance information has a predictive or confirmative value. Predictive value means they help users to forecast future events. I remember when I was an investment analyst, I use financial statement, always predicting whether this company is going to perform well or not. Okay, but at least have the predictive value. Okay, analyze the company when it's go to for an IPO, whether the company is going to perform as expected or not. Confirmation value, confirm correct prior expectations. Okay, materiality also is an important component of the relevance. Okay, as item of material, it will influence the decision making. For example, you have to make sure the most important for in the investment analysis is an earning per shares. That's the value of stock. Fundamental characteristics: faithful presentation. Information must be faithful presentation of economic reality or reported event. Concept known as a substance over form. Okay, this achieved when the information is complete, include all necessary information. Neutral information is free from bias, such as prudence. There must be a prudence in managing with care and economic frugality. Free from material error, will not affect the decision by investors and creditors. We have seen a number of problems in the past from Enron, where all the financial statement goes down the tube because of the false representations. Arthur Andersen and Enron, they all bankrupt because of that. We have also seen in AAG cases where the financial is ballooned because of the window dressing activities. So the key part in the financial statement must be faithful representations. Okay. Enhancing qualitative characteristics comparability. The similar companies use the same accounting policy. That's the key part. Okay. Consistency. Company use the same accounting policy from year to year. Okay. That's the key part. Consistency. If you use double declining, you're going to continue double declining method for your depreciation. However, accounting can change due to new requirements that have been issued when managers decide the different policy given the more relative information. It can be done that way, but it has to be noted and advised in the financial statement. Accounting changes are disclosed in the financial statement. That's the key part. Accounting changes disclosed in the financial statement. So if there's any changes in your policy in terms of calculation, you have to disclose it in your financial statement. Verifiability and timeliness in terms of enhancing the quality of characteristics. Verifiability means assure user to the accounting information shows the economic reality of the transactions. Information is verifiable if two knowledgeable and independent people agree that it is faithful represent the economic reality. Timeliness. Accounting information is provided when it is useful for decision making and available to the decision maker before it loses its ability to influence their decisions. Then, information enhancing qualitative characteristics in terms of understandability. Information must be understandable to user for it is to be useful and able user to interpreting and comprehend any information in the financial statement. User assumed to have reasonable knowledge in terms of business, economic, as well as financial activities, and in terms of financial reporting. So the difference between qualitative characteristics under IFRS and ASPE is that ASPE identify four principal characteristics. Understandability, which is higher status under ASPE than IFRS. Relevance is important under ASPE and IFRS. Reliability is considered reliable is this used it is a faithful representation and comparability a higher status under SP than IFRS. Okay. The recent quantitative continue that ISP include conservatism as a component of reliability, which is similar to the concept of prudence in IFRS. Learning objective number 4, applying the recognitions and measurement criteria of the consensual framework to financial reporting situations. Okay, in terms of recognition and measurement criteria, accrual basis of accounting transactions are recorded in the period which the event occurred rather than the cash is received or paid. Recognition criteria help determining when items should be included in financial statement. Measurement criteria guidance for what the amount should be recorded. In terms of general correction, a type is usually included in the financial statement if it means the division of asset, liability and equity, and revenue and expenses. It is probable that any future economic benefit associated with the item will flow or to from the business. It can be measured and a reasonable estimate to the amount can be made. Also must meet the fundamental qualitative characteristics of relevant and faithful representations. Recognition of side liability, two important concepts under the general recognition area is as follows. Number 1, if an asset is going to be recorded, must be probable that the future economic benefits will flow to the business. If a liability is going to be recorded, it must be probable that future economic benefits will flow from this to the present obligations. Revenue criteria, revenue should be recognized at the same time that an increase in asset is recognized, a decrease in liability is also recognized. Due to ordinary profit generating activities that result in an increase of equity. There's two approaches of revenue recognition. The first one is contract-based approach, require the company follow IFRS, also known as the asset liability approach. Earning approach is a standard used by ASPE. Okay, based on the revenue recognition contract-based approach, it is based on the enforceable right and obligation in a contract with the customer. Seller will recognize revenue when a promised good or service are transferred to the customer, such as performance obligation is complete. Amount that is recognized reflect consideration expected to be exchanged, such as seller promised to deliver goods or services and customer agreed to pay amount of consideration in exchange. For example, I promised to deliver samosa, 5,000 of them. Then when I delivered, BMO will transfer the money to me for the payment, my customer. Okay. Contract-based approach of 5-step model revenue collection. There's 5 of them. Number 1 to 5. The first one, identify the contract with the customer. For example, so identify the contract with the customer. I'm selling my samosa to BMO, for example. Identify the performance obligation in the contract. I must provide 5,000 small with a certain taste. Let's say spicy taste. Okay. Number 3, determine the tax expense. Let's say one samosa is equal to $1, so total 5,000 is 5,000. And then under step 4, allocation the tax price and performance obligation. So I provide the bill 5,000. Step 4, number 5, recognize revenue when the performance obligation are satisfied. When I deliver the samosa to BMO, then BMO will pay me $5,000. So that's basically step 1 to 5. Okay. Variable consideration, any amount that may consider receive, such as, to come an example, the right to return and sales discount. There's another example, right to return and sales discount. Let's say the samosa is not good, one of them, let's say stale, then they have the right, the customer have the right to return it. Sales discount is that if the company able to pay earlier than 30 days, then I give them a 2% discount because they pay early. Okay. If revenue is recognized without attention to variable amount, revenue is overstated. Contract-based approach requires seller to estimate variable amount when determining the transaction price. Okay. In terms of revenue recognition, earning approach, sale of goods, revenue is recognized when all conditions are met. For example, performance complete, signal and trace, the reward have transferred from seller to buyer. Seller no longer control and manage good. Revenue can be reliably measured, probably increase in economic resources, cash collected. Cost related to skill can be reliably measured in terms of critical events. For example, I deliver my samosa to BMO, then I recognize that revenue. Revenue recognition right of return. If revenue is recognized with a constraint of the potential revenue will be overstated. Okay. It will be overstated. Under contract approach, revenue recorded at the amount expected to be received, that net amount. Under earning approach, record revenue and adjust revenue return. This is how you're gonna two different approach. In terms of right return, contract approach, revenue recorded at the amount expected to be received, which is the net amount. Under earning approach, record revenue adjust revenue of the return. Excuse me. Warranty, in terms of warranty, accounting is the same under both contract-based and earning approach. Assume warranty requires provision for the future warranty to be incurred. Service warranty accounting for multiple performance obligations. Okay, warranty example, you buy a car, the company usually provide a warranty in terms of driving up to certain years, 3 years, and maybe after 30 years, up to 48,000 miles, something like that. Okay. In terms of expense recognition criteria, expenses are recognized when there is a decrease in asset and an increase in liability, excludes the distribution to owners. Not necessarily when pay cash is paid, can be directly associated with cost incurred and revenue earned, matching concept. When there's no direct relationship, either another systematic and rational collection approach may be used. Okay. In terms of measurement of cost, acquired asset are recorded cost. Cost is used because of the following relevance: represent the price paid and asset sacrifice or the commitment made at the date of the acquisition. Faithful representation is objectively measured, factual, and verifiable. After acquisition, cost is referred to the historical cost. So, most companies use historical cost model to report the property and plant equipment. Under IFRS, you can choose re-evaluation model, such as fair value is the fair market value of asset and liability at the reporting date, and the amount of cash expected to be collected when asset is sold. Some asset is more relevant than the useful cash. This is an example of the measurement of cost model or re-evaluation model. This is typical for the standard practice for IFRS. Under IFRS, choose the evaluation model. Okay. In terms of measurement element current cost is amount cash equivalent that would have to be paid in the same equivalent asset and was to be purchased in the current period, or the investment cost or amount required to settle obligation currently. In terms of realizable value and present value, in terms of measurement amount, there's two definitions here. Realizable value is the amount that can be reasonably and expected to be collected or cash to be paid to satisfy liability. Inventory is measured in this way. Okay, realizable value for inventory for present value is based on the present value of future cash inflow or outflow. In terms of error and in misstatement, revenue and expenses may be misstated by recognition and the incorrect accounting period, misstatement estimate, failure to record revenue and expenses, failure to comply with the correct measurement, and then important analyze transportation carefully to ensure that accounting principles are applied correctly and faithfully represented. Okay. Learning objective number 5, apply the fundamental concept, assumption, and constraint to the conceptual framework to financial reporting situations. In terms of assumption, constraint 1 to 4, reporting entity concept. Okay. Integrating is for reported activities must be kept separate and distinct from those that activity of owner and all reporting entities. And there's a going concern assumption, assume the company will continue operating in the foreseeable future. In terms of monetary concept, money is common limiter of economic activity, prevent recognition element that cannot be quantified, such as employee morale and loyalty of the customer. Predicate concept guides the business in dividing their economic activity into distinct time periods such as months, quarter, or year. In terms of full disclosure concept, requires disclosure circumstances that event that make difference in financial statement users. It is accomplished through data in the financial statement as well as in the notes of the company, and statement is a summary of significant accounting policy and usually the first note on the financial statement. In terms of cost constraint, the value should be greater than the cost of providing it. The benefit of reporting should be justified at the cost. Also, non-benefit versus the cost constraint under SPP. So this basically conclude, the copyright of this particular chapter is owned by John Wiley. Okay, thank you for listening. I will put this as well in YouTube as well as available in Edpuzzle, so you can practice this particular chapter 11. Thank you. Hope to see you again in the next chapter. Bye bye.